Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over a couple of questions that people have on Twitter. They wanted my opinion, and I'm going to give you my opinion. So let's dive in. I'm going to give you my financial opinion. Again, guys, this is just my opinion. Please don't use it as advice. But you'll get another viewpoint of what my viewpoint is and kind of perhaps the way that I'm looking at all this stuff. So if you want to follow me, again, it's at finding_finance. And here's the question. It says, interesting reading, finding finance. What are your thoughts? So I click on the thread. It's a pretty big thread. It says, we're at a key inflection point for the gold industry today. Due to the overwhelming pressure to adopt the green revolution, there's been a declining interest from miners in deploying capital to gold-focused projects. Perversely, it's very bullish for the industry. So he goes through, talks about the 1970s. Among it is multiple idiosyncrasies causing the metal price to rise in each of them. A multi-year decline in gold production worldwide. So if we were to go and look at some of these patterns here, and I've showed this before on the channel, these are gold prices. Then you get that long sideways movement, gold price sideways movement, and so forth. Each time the gold price has gone up dramatically, we've seen global gold production decline each of those times. And now we're going into a global gold production decline, perhaps, and it could be quite dramatic. We've seen that new findings in gold in terms of ore grades have really declined. And when I look at a lot of this and I look out into the future, the spots that I think get a little bit funky is oil and energy. So I'm gonna tie it back to that. Just keep that in mind that my concerns are around energy and that we've got declining global gold production. So we go through these other things. These are the miners and gold production in millions of ounces, declining for Barrick Gold, declining for Anglo Gold, declining for Kinross, declining for Gold Fields, etc., etc. So many gold-focused miners have significantly shrunk their production. And we've seen that in a lot of different commodity industries. It's not just gold, but we're talking gold here. So he talks about the declines in some of these. He says oil and gas stocks become uninvestable for many institutional investors, having to follow certain ESG mandates over the last decade, and I think that's why I think that's probably going to be one of the best areas for investment. Ironically, the aggressive push for new wind and solar renewable energy production has created a ferocious demand for hydrocarbons. I agree with that. Although, so we go here, the gold reserves by the top 10 miners declining dramatically over 2011 versus 2022. So their gold reserves are declining, down 33%. This is the average grade for existing gold reserves. You can see that the grams per ton is declining rapidly over that time frame. This was over 2.3 in 06. We're now to 1.55 is the average grade. Coming on through, global central banks are buying record purchases of gold during this long-term base. That's interesting as well. We've got gold and silver miners net acquisitions versus cash flow coming up a little bit in aggregate net acquisitions. The gold and silver miners cash levels, highest cash levels in history. So they're making good money. Additionally, precious metals mining companies just went through a long deleveraging process. There's their debt deductions or deleveraging over that time frame. Gold and silver miners, CapEx is a percent of cash flows. Coming on down for CapEx, and that is the entire thing here. So I'm going to give my opinion here as we're just kind of going through this thread together. I know a lot of people want to invest in the mining companies. I do have some investments in mining companies. It's not a lot. When I look at this from a big picture view, and I look at the entire picture here, all right, a lot of this is going to deal with how costly energy is. That could be energy return on energy investment. You could look at that, or just the flat out cost of it. If energy goes up dramatically, I'm talking dramatically, I don't know how much these gold and silver mining companies are going to make, but I do know that their cost curves are going to go up with declining ore grades. And with the decline in production, I'm pretty sure the metal's going to go up. So then it becomes a risk reward situation. Do I bet heavily on a small junior company with super low ore grades in an environment where I don't know where they're going to get the energy? I'm not going to take that bet. I mean, I'll put maybe a little bit of money on it, because if I'm wrong, but I'd rather go right to where the problems are. And right now, I think the biggest problem in the market is oil. Why? Because what they did, they being governments, and it seems like everyone's doing this around the world, is they are underinvesting in fossil fuels. And they are putting all their money into this option A, and option A is not working. Well, then everything's going to have to rotate to option B, and they don't want option B to be fossil fuels. So I think that the world's going to be forced into adopting a couple of different things in mass. I think nuclear power is going to be something that they're going to have to adopt, period. Bar none. Doesn't matter what people think. It's a physics problem. It's not, oh, well, we can say, doesn't matter. It doesn't matter. You don't go down the energy return. You don't go backwards. You always go forwards. Nuclear is the thing that goes forward. So when someone says, oh, nuclear is not moving, doesn't matter, guys. Doesn't matter what the price is doing in the short term. We have to go that direction, in my opinion, because that is where you jump up the energy pyramid, the energy return on energy investment period. You got to jump upward. You don't jump backwards. And I think we're going to have to do it because of mineral constraints in the world. Mineral constraints. Now, there's another thing that's happening alongside this. It's not just the deficits of base metals, the deficits of all these different things that's going to force us down the nuclear path of higher energy returns and higher energy return on mineral intensity. It's not just those two things. That's part of one topic. The other topic is we have a debt system that is increasing exponentially. It's got to go up and up and up at an exponential pace. Our GDP can't follow that fast. What does that mean? It means that banks, these big banks, when we showed you that chart where the central banks are buying all this gold, they know what's coming. They're buying gold for a reason. We should be doing the same. We need to be separate from currencies and bonds. So when you look at this and you look at currencies and bonds, that is a future repayment. That is debt. You don't want debt. You want to get out of debt, and you want to hold the final payment. So physical gold in your possession, physical silver in your possession, physical anything in your possession, platinum, palladium, doesn't matter what it is. It's all going to smoke, in my opinion, these debt-based currencies and debt-based treasury bills and all this other garbage out there. So there's that going on as well in the near term here. Now, what backs GDP? How do we grow our way out of this, right? If you have an exponential debt going like this, it's going to put you in a hyperinflation, or everything goes bust in a collapse, a deflationary collapse. So what usually happens is governments decide to print the money and default through an inflationary default. It's not through a deflation. And I'm just describing the market conditions here so you guys can understand the answer I'm going to give for this. So you've got this increasing debt that's going up exponentially, and you have a GDP that's going to get stuck because of energy constraints. We've seen this in Europe. We know exactly what the problem is, right? Energy constraints, inflation goes ballistic. We've seen it already in Europe. That is a prelude to what I think the entire world's going to experience at some point in our future. So if you don't invest in fossil fuels and you can't grow your GDP, but your debt has to grow at an exponential pace, that is your problem. Now, we're going to see this all happen at the same time that we see gold production, silver production, all the production of a lot of these things start to either taper off or decline for a period of time. It's going to be a massive bull market in those areas. Now, as these decline in ore grades go down in everything, and as the production goes down in all of these different things, the thing that it's going to hinge off of here is how much energy do we have to go after these low ore grades? That's the question. Do we have exponential amounts of energy to go after these low ore grades of all these things? If the answer is no, your best investment is energy. Because all these guys that have low ore grades in base metals, in gold, in silver, extra, et cetera, et cetera, et cetera, they're all going to run at energy. So the people who win in that scenario are going to be the energy producers. And they may or may not be able to increase production just because people are running at it. Doesn't mean they're going to get this gigantic volume of flow out of oil. We may not get as much as what people think. So energy would be the best investment in that type of scenario. If we have an exponential amount of energy that we can grow into, then the mining companies with these low ore grades would be incredibly good deals. They're the ones that are going to make the money. But if we have exponential energy that we can grow into, then that means that our debt problems would only be temporary. They would not be permanent, and we would not go potentially into a hyperinflation. And you'd have to have a source of energy that is far exponential. And you'd have to eat through our commodities like no other to keep that growth, GDP growth, with the debt growth. So when I look at the risk reward, and I look at this and I say, I don't think we can increase production of oil by 20%. I really don't think we can. I don't think we got 120 million barrels in us. I don't think so. I don't even know if we've got 110. It'd be interesting to see, but I don't know if we can ramp it and offset the declines and keep it at 110 for a long time. I don't know. Be interesting to see if we can do that. But if I have that mindset, then I'm going to go invest in the physical metals themselves and say that these mining companies are too risky to me. Now, that doesn't mean I'm right. That's just one opinion. But the risk reward in the physical metals, I think, is unparalleled. Because if we do have a constraint and the money system has a problem, then I think the physical metals will be the things that'll be worth the most. And then the companies, they could go up dramatically, mining companies or whatever, but I don't know. I don't have that draw to them. I don't have the, like I need to be in it feeling. And I don't have that feeling in a lot of different things. Like when I look at charts and I look at companies, there are certain things that, and I know it gets to kind of an emotional feeling type thing, but I look at it and I think through things logically, and then I have to have a feeling too, like I have to be in it. Like I got to own something, a part of this. And it can be in different companies, like diversified mining companies. They have a diversified bucket of base metals. I know that diversified bucket of base metals is going to be in large need in the future. And I also think that the shortages could be great enough where it's going to be difficult to source some of the inputs. So a company that's very well capital, they've got a lot of capital, they're a big mining company, and they have all the infrastructure in place. I see that as a really low risk way to play a gigantic base metals boom. Now, a company that doesn't have a mine in place, doesn't have the infrastructure, doesn't have any of these things, that's just far too risky to me. Doesn't mean I'm right. Maybe they go up, maybe they'll be the best performing thing this next bull market. I don't know. But I think that we're bumping up against, at some point here in the next 5-10 years, the capability and capacity of oil. If that's the case, and we do it for coal as well, and natural gas will be behind it at some point. Coal, because of the energy densities, lignite versus what's the other one? Whatever it is, the two different types of coals. I think that it's going to be more difficult to get these low ore grades out. I think it's going to be more difficult to build a mine. I think it's going to be far more expensive to do all that stuff, which means your cost curves go up. Means the mining companies may not make as much money, and they keep a smaller margin. Like maybe they only keep 20% margin, but the cost curve goes up with the price like this. And you'd be better off just buying the metal itself. And that is only the physical metal. And that's only if what I'm saying is true, where I think there's going to be a large adjustment in the price of energy. But that's where I think that's where we're going to go. So I'd rather hold the physical metals. I'd rather be in the physical metals and not deal with all the risk of a mine not getting developed, of a mine not having the metals to put the infrastructure in place, a mine not having the diesel to run, or the whatever problems they encounter, or a government saying, we don't want you to build this mine now for whatever reason. That's kind of my viewpoint. And yes, I think that this could be a very good investment opportunity as long as we have got a bunch of energy. And it's not just cheap energy, guys, in going to a more expensive energy source. It's the energy returns. The energy returns. So, like, for instance, and I'm going to do a basic math here, all right? This is nothing too ridiculous. I'm just going to say that our energy returns decline rapidly. So, let's just say at 80 million barrels a day, I know this isn't current production, but let's just say it's 80 million back a little bit. But your energy return was a 50 to 1. All right, let's just say 50 to 1. So what we do is we would divide by 50, and you'd put 1.6 million barrels of energy to get the 80 million. Now, if we were to do all oil sands, and this was an 80 million barrel, and it was off oil sands, and it was only a 4 to 1 return, divided by 4 equals 20 million barrels. So that is an increase of 12.5 times. We are putting that much more energy to get that oil in return. It's a 12.5-fold increase. So in order for that to be equivalent, if you had 80 million barrels, it'd be 80 million of the original plus the 1.6, right? And let's say that's kind of what you had to produce to get 80 million in energy to the system. In order for the other system to work, if you want 80, you have to produce 100 million barrels, 100 million to get 80. And what happens is, if you want to hold the energy to society flat, and as you go after lower and lower energy returns, your volume flow has to increase dramatically for that to happen. So we can go to 200 million barrels, but we might be treading water at where we are today for usable energy to society. If that makes sense. If our declines of energy returns decline that rapidly, and we go to solar, and we go to wind, and we go to these lower returning fossil fuels. So it's not just about volume, it's about usable energy to society. So then the question is, if we're finding 1 gram per ton gold ore grades, and they're in the middle of nowhere, are those going to be produced? I don't know. They may never be produced. There might not be any value in it, because of the energy intensity to get it, the cost of energy. So if we're trying to look at this paradigm from looking backwards forward, and we want to bring on all these things, and it's just, everybody thinks it's just a matter of cost. Your cost should be measured in energy. What's the energy to get this out of the ground? And how much is your energy going to cost in the future? And is it even feasible to do it? Now, if this is the case, what you basically have now is gold in the same situation as Bitcoin, where you have a limit on how much gold is above ground. And no more is really going to be produced in the future because of the energy it takes to get it out of the ground. And that's where all the value could be. that's kind of how I'm seeing this, looking at a very big long-term, big picture view. And I don't know if I'm right. Maybe we have a cheaper energy source. Maybe we find something. Maybe we don't. We have not created energy. We've only gathered it from our surroundings. We've gathered it from Earth, dug it out, drilled it out, mined it out, sucked it out, pushed it out, whatever it is. We've never created it. It's only been gathered. Or we gather it from sunlight, we gather it from wind, we gather it from something. Moving water, from gravity. So that's where my head is. I'm not going after these junior mining companies just because the ore grades are so low. And maybe there's some really good investments there. Maybe they do incredible things. That's fine. But I've been going after the physical metals, the stuff that's above ground in my hands. And how valuable would that be if the production falls to a very low level because of energy? We've already seen Europe with high inflation rates. Inflation rates going vertical. A recession is going to happen. Yes, I agree with that. But what's the cause of the recession? How come this is all happening? They printed a little bit too much money. The debts are going vertical. All that money is basically future claims on energy. And energy is telling you that we don't have enough energy out there. That is your constraint. That's where the money's going to go. It's going to go to energy. So you've got two things that I kind of think of here. I want to be a part of the energy investment, especially those that are limiting the most. Oil is one of those. Coal would have been a good one. I kind of feel like I missed the boat there. So I'm not going after that. But I'm heavily in natural gas and oil. Those are the ones that I think will do incredibly well. So I'm going to stay long that. Doesn't matter what the volatility looks like. The problem here is, if I win big. And with these companies being so cheap, even if I lose, everyone loses. Because that means that GDP isn't growing. And the other factor of this is I like physical metals quite a bit. Why do I like physical metals? Because if you have a debt that's growing exponentially and you have a GDP that can't grow, you have an inflation problem. Go look at Germany. Go look at the UK. You start having bond problems and debt problems, currency problems. So energy is one spot, physical metals is the other spot. And that's where I'm going to live. Those areas. Yeah, I've got some diversified mining companies. Yes, I have some physical or some precious metals mining companies and some precious metals royalty companies. And I've got some lithium and some other things that I think, on the fringes there that may or may not work. But those are my focuses: physical metals, energy-related investments, and energy service companies and those types of investments as well. So, that's kind of how I look at it. Maybe I'm right, maybe I'm wrong. But that's my investment approach. I don't think you can really lose too much in physical metals because I think that's where everybody's going to end up running at. And even if they don't run there, they still do well historically, even under a surplus in energy that we can grow into. They did well in those environments too. So I think that's kind of the lowest risk, highest reward, because the risk is so low in it that I've got to have a good chunk in it. But again, guys, that's just my opinion. It's not advice. It's just my financial opinion. That's how I'm looking at it. That's how I'm playing it. So that's what I've got. If you guys need help in this commodity bull market, definitely check out finding-value.com, the Platinum membership. You can see the companies that I own. They're very well aligned with what I just described before this. If you like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And we'll catch you later. This is Finding Value.